fundsupermart.com.
I want to start the interview by getting your outlook for the Singapore market. Where do you see the Singapore market going, or what sort of factors do you see emerging in 2012?
Maybe start off on the economic side. I think 2012 will be a challenging year, quite clearly. I mean, from the macro front. And I think the reason is very simple, because if you look at the Singapore economy, it's a very open one. So if you look at our export to GDP ratio, we're talking about over 200%. And unfortunately, if you look at all our major trading partners, the US, Europe, even Japan, or even China, if you talk about it, they're not doing well, or they're facing very challenging times. So given this kind of backdrop, export is going to be a major challenge, a drag to our economy. So that is, I think, the picture right now. An additional, I think, drag is, in my mind, the property market. If you look at past cycles, every time there's a strong property cycle, up cycle, the economy will have a lot of spin-off benefits. Investments will be up, confidence will be up, even consumption, even for a small economy like Singapore. So my feeling is that the property down cycle has just begun, unfortunately, and it will have major implication for the domestic side of the economy. So on both fronts, it doesn't look that fantastic, external as well as domestic front. The only positive which I may highlight is that a lot of this is discounted in the Singapore market. If you look at the valuations of the Singapore market, let's say by PE, is a low double digit, and traditionally look at, it's actually about -1 standard deviation from the mean. So that tells you there's some value. Even if you look at what corporates are doing on share buybacks or even directors buybacks, it's also hitting some all-time high numbers as well. So we have a bad economy, likely to be quite clear. Valuation has reflected that. In the near term, we think that the news flow that you're going to hear in the global economy, whether it's Europe, US, is going to be negative, unfortunately. And the market is going to be very volatile. So you have to have a medium-term investment time frame. Then I think things will be a little bit more interesting.
Okay, well, we've talked a lot about the risk, but for now, I just want to get your view on what are some of the positive factors. I mean, you mentioned that some valuation measures are fairly attractive. What are some of the other positive drivers do you see that you can see in the Singapore market?
I think the only thing that we can talk about positively, unfortunately on the medium term, is valuations. And valuation, if you look at it from PE, for example, is trending much below the traditional mean. So we're talking about 11, 12 times PE. That's very low for Singapore market, whereby if you look at corporate balance sheets, they are as best as you can get in the last 10 years. So the corporates are able to withstand this so-called wild ride, number one. And number two, when things start to stabilize, eventually you're likely to make good returns from the market on the 2 to 3 year time frame. So I think that is the major positive that I can talk about. On the macro front, on what is going to happen to the economic side, very tough, very tough. In Europe, for example, it's going to be a very difficult period for them. Actually, one major theme, if you look at what is happening on the macro front, external front, is that all our neighbors, major trading partners, they have over-leveraged themselves through the years. And we have come to a point whereby they are being disciplined by the market, in this case by the bond market, to do substantial fiscal cutbacks. And fiscal cutback, unfortunately, will lead to recessions. So for example, in Europe, we think the chance of a recession is quite high. We just hope that the recession will not be so deep, else we'll be in trouble as well. Europe is no better. US is no better. Unemployment is still very high, 9%, and it's hard to see how how things can turn around so quickly. And they also have substantial fiscal cutback to do. So on all fronts, macro, I would say is gloomy. The good thing is it's in the share price. So if you have the time horizon, you have the risk appetite, it's time for you to start accumulating.